for stocks. Rob, nice to see you. What's been the most common question you're getting from some of your clients these days?
How do I make more money? There's a ton of stuff. And by the way, thanks for having me, guys. I even wore a suit for you guys today, shirt, tie, suit, everything. So great to be here, John. I appreciate being here. The question that we definitely get more is, I don't want to miss out. I want to be in on SPACs. I want to be in on crypto. I want to be on, the hot new issue. I want more. I want more. I want more. We're seeing a little bit of greed, definitely, from stuff that we normally don't talk about much as portfolio managers. So that's definitely something I'm seeing a lot of in the last, I'll call it 3-4 months.
And how do you feel about that? Feels almost like FOMO that investors are directing your way.
Yeah, I mean, Mr. and Mrs. Retail investor that have accumulated $1 mil or $2 mil, they sold their business, they're kind of quietly drawing that down from a corporation or whatever it may be. Does it make sense for them to own SPACs, John? I'd say no. Does it make sense for them to own the hot new issue? I'd say no. So, we want to make sure we own quality. We want to make sure we want to outperform, obviously, but we're definitely not going to do it by taking on more risk. So it's a conversation you're having, especially with people that are coming out of the woodwork that you never thought would want to be, participating in this kind of risk play, this kind of leveraged play. Our job is to make sure that they're not taking undue risk for the wrong reasons. And most of the time, the conversation we're having now is people wanting to take risk for the wrong reason.
Yeah, it's the reality when all boats are being lifted. It's hard to ignore that. It's when stuff's moving in the other direction when the conversations are typically harder. But let's just talk about some of those areas where investors have been gravitating outside of the fancy new stuff. When we're in a typical recovery period, a lot of people look to some of the cyclical plays. We've talked extensively about that on BNM Bloomberg. You've seen a lot of interest in this country where the TSX has outperformed this year. In the energy sector, we're talking a lot today, for example, about OPEC and the partners and what they're going to be doing when it comes to production going forward. How do you feel about the commodities area for an investor who's looking to capture some outsized returns going forward?
It's funny that, the last couple times I was on in 2020, we talked about this energy play, and I specifically said, nobody's buying it right now. No retail regular individual investor is looking to add a ton of energy to their portfolio. One, they don't want it for a lot of reasons, globally, macro, politically, socially, economically, they don't want it. But two, it's lost money for 3-4 years. The stock's at a all-time low. I don't want to touch it. And I said, that's usually the time to get in. And obviously that ended up being true. So one, you're dealing with people who don't want to have energy at all in their portfolio because they're scared and they're worried about the potential future and another crash. But two, you got this fear of investing in it, kind of let's save the planet. So if you are not one of those, I would definitely say, one, if you want to just stick, an easy way to play it is you stick to the Canadian large caps. They're trading at ridiculously low multiples. And this is not the ninth inning of this. Like, we are in this second or third inning. A lot of money has already been made. But if you believe in this cyclical sector rotation into energy, we're going to have another 3-4 years of kind of emerging growth. And, we had a phenomenal GDP number that came out yesterday. If you believe that is going to continue, the reopening trade, that people are going to fly, like, the easy way to do it is obviously to just pick up the large caps. They're phenomenal. But if you want to quadruple your money, obviously you got to look at some of those small caps that are trading at numbers that they're nowhere near the last time oil was at $60.
When you talk about small caps, you're talking about the plays that are really essentially leveraged to this better oil price environment.
Yeah. So you have a lot of these small cap companies that had to hedge. They had to put on hedges by, back when oil was, negative or at $0. They had to put on a whole bunch of hedges 1 year out, some of these. And we're now, March 3rd, we're now about a year out from that. And some of these hedges are now going to come off, meaning that they can actually sell their oil. A WCS is at $50. John, we've been following that number for a long time. It doesn't often touch $50. So, or hasn't recently, let's put it that way. So you have these small companies, highly leveraged, they might have a cost of $40 and, they're making $0 at 40 WCS. But at 50 or 60, now they're phenomenally profitable, and the stocks are no longer worth 60 cents. That, in theory, they should probably be worth $3.
Hmm. And the energy sector itself, the broader sector here in Canada, up about 14% this year. As a group, it was up yesterday compared to, say, the NASDAQ, which was down yesterday. Technology is this interesting one, isn't it, Rob, in the sense that, it led us higher last year. Most of the big companies are printing money. But right now in this environment, this recovery story, they seem to be losing momentum. How do you feel about tech at this stage of the rally?
I just don't think you can get away from it, John. You cannot be underweight tech for the next decade. Like I've been saying for a lot of years, for the last 7 or 8 years, that you got to be in this space. You have to be in it because it's revolutionizing how we live and how they're creating economies of scale that we never thought were possible. They're figuring out new ways to create value, to add value that are outside of our traditional kind of realm, and that's not going to change. Evolution is happening in that sector, and you want to be a part of it because the evolution increases your shareholder return on equity annually, in my mind. So the multiples that we're seeing here, I mean, obviously there's some companies that are trading at absurd multiples, John, and I don't want to be part of that. But some of the large cap tech, you look at a Google where it's trading at 40 times earnings or whatever it's trading at. Do I want to own that? Of course I do. And I want to own it for the next 5 years and 10 years and 20 years because they're going to revolutionize and they're going to figure out new ways to create and add value for shareholder equity. And maybe short term here for the next year, maybe cyclicals outperform, quite possible, but you just can't afford to be away from that. And you have to continue, in my view, to own that in your portfolio.